India, a land of vibrant culture and immense potential, has witnessed remarkable economic growth in recent decades. Its journey from an underdeveloped nation to a rising economic powerhouse has been nothing short of extraordinary. However, in recent times the Indian economy has hit a rough patch, experiencing a significant slowdown. This slowdown has raised concerns among policymakers, economists, and citizens alike. For years, India was hailed as a beacon of economic hope, with its GDP soaring to new heights. The nation's youthful population, coupled with a burgeoning middle class, fueled a consumption-driven growth story. Foreign investors flocked to India, eager to capitalize on its vast potential. But the winds of change have swept through the Indian economy, leaving behind a trail of uncertainty and apprehension. The slowdown is evident in various macroeconomic indicators, painting a somber picture of the current state of affairs. GDP growth has decelerated, falling short of expectations and raising alarm bells. The once booming manufacturing sector has lost its momentum, struggling to create jobs and contribute to overall economic expansion. The agricultural sector, the backbone of the Indian economy, is grappling with its own set of challenges, further exacerbating the slowdown. As India grapples with this economic downturn, it is crucial to understand the factors at play and explore potential solutions to steer the nation back on track. The road ahead may be challenging, but with decisive action and prudent policies, India can overcome this hurdle and reclaim its position as a global economic powerhouse. Gross domestic product, or GDP, the total value of goods and services produced in a country, serves as a key indicator of economic health. India's GDP growth rate, once the envy of the world, has been on a downward trajectory, raising concerns about the country's economic well-being. A slowdown in GDP growth reflects a decrease in economic activity and can have far-reaching consequences. The declining GDP growth rate is a cause for concern, as it indicates that the Indian economy is not producing and consuming goods and services at the same pace as before. This slowdown can lead to job losses, reduced consumer spending, and lower investment. A shrinking GDP can also impact government revenue, limiting its ability to spend on essential services and infrastructure development. Furthermore, a prolonged period of low GDP growth can erode investor confidence, making it challenging to attract foreign investment and stimulate economic activity. To revive GDP growth, India needs to address the underlying factors contributing to the slowdown. These factors include both domestic challenges, such as weak private investment and agricultural distress, and external headwinds such as global economic uncertainty. Employment is crucial for economic growth and social stability. When people have jobs, they earn income, spend money, and contribute to the overall prosperity of a nation. However, India is facing a growing unemployment crisis, which poses a significant threat to its economic prospects. The unemployment rate, which measures the percentage of the labor force that is unemployed, has been steadily rising, particularly among young people. This high rate of unemployment has far-reaching consequences for both individuals and the economy as a whole. For individuals, unemployment means a lack of income, which can lead to financial hardship, poverty, and social unrest. It can also have a devastating impact on their mental and physical well-being. From an economic perspective, high unemployment means that a significant portion of the workforce is unproductive. This results in lower output, reduced consumer spending, and slower economic growth. The lack of job opportunities can also lead to social unrest, as frustrated youth, deprived of economic opportunities, may resort to protests and other forms of dissent. Addressing the unemployment crisis is paramount for India's economic and social well-being. Interest rates are a powerful tool used by central banks to influence economic activity. They represent the cost of borrowing money and the return on savings. In response to the economic slowdown, the Reserve Bank of India, or RBI, India's central bank, has reduced interest rates to stimulate borrowing and investment. Lower interest rates make it cheaper for businesses to borrow money for expansion, and for individuals to take out loans for homes or cars. This increased borrowing and spending can boost economic activity. However, lower interest rates can also have some drawbacks. They can lead to inflation if the increased demand for goods and services outpaces supply. Additionally, lower interest rates can discourage savings, as people may be less inclined to save when returns are low. The RBI faces a delicate balancing act in managing interest rates. It must strive to find the optimal rate that supports economic growth without fueling inflation or discouraging savings. Inflation, a sustained increase in the general price level of goods and services in an economy over a period of time, is a persistent challenge in India. When prices rise, the purchasing power of money erodes, meaning people can buy less with the same amount of money. Inflation can be caused by a variety of factors, including supply chain disruptions, rising global commodity prices, and excessive demand. In India, food prices, which make up a significant portion of the consumer price index, are particularly volatile and contribute significantly to inflationary pressures. High inflation disproportionately affects low-income households, as they spend a larger proportion of their income on essential goods and services, which are most affected by price increases. To control inflation, the RBI may raise interest rates to curb borrowing and spending, but this can have a dampening effect on economic growth. The government can also play a role in containing inflation by implementing policies to improve supply chains, enhance agricultural productivity, and regulate prices of essential commodities. The debt-to-GDP ratio is a crucial indicator of a country's fiscal health. It measures the size of a country's national debt relative to the size of its economy. A high debt-to-GDP ratio indicates that a country has a large debt burden compared to its ability to generate income to repay that debt. India's debt-to-GDP ratio has been on the rise in recent years, raising concerns about the country's long-term fiscal sustainability. This increase is partly due to the government's efforts to stimulate economic growth through increased spending and tax cuts. While these measures may provide a short-term boost to the economy, they can also lead to higher debt levels. A high debt-to-GDP ratio can have several negative consequences. It can lead to higher interest payments, which can crowd out other essential government spending on areas such as education, healthcare, and infrastructure. A high debt burden can also lower a country's credit rating, making it more expensive to borrow money in the international market. In addition to the factors discussed above, several other issues have contributed to India's economic slowdown. These include weak private investment, global economic conditions, agricultural distress, and banking sector stress. Private investment, a key driver of economic growth, has been sluggish in recent years. This is partly due to a lack of confidence in the economy and concerns about policy uncertainty. Global economic conditions, such as trade tensions between major economies and slowing global growth, have also had a negative impact on India's exports and overall economic activity. The agricultural sector, which employs a significant portion of the Indian workforce, has been facing numerous challenges, including low crop prices, rising input costs, and climate change. These challenges have led to farmer distress, rural indebtedness, and a decline in agricultural output, further contributing to the economic slowdown. The banking sector, which plays a crucial role in channeling credit to businesses and individuals, is grappling with a high level of non-performing assets, which are loans that have not been repaid. Reviving India's economic growth requires a multi-pronged approach that addresses the structural weaknesses and external challenges facing the country. Firstly, India needs to create a more favorable investment climate to attract both domestic and foreign investment. This can be achieved by reducing bureaucratic hurdles, improving infrastructure, and ensuring policy stability. Secondly, addressing the challenges in the agricultural sector is crucial. This includes investing in agricultural research and development, improving irrigation facilities, providing better access to credit for farmers, and promoting crop diversification. Thirdly, India needs to continue its efforts to strengthen its banking sector by addressing the issue of non-performing assets, improving corporate governance in banks, and enhancing regulatory oversight. Fourthly, investing in education and skills development is essential to create a skilled workforce that can meet the demands of a modern economy. Finally, India needs to engage constructively in the global economy while diversifying its export markets and reducing its dependence on a few key trading partners. By implementing these reforms and addressing the challenges it faces, India can lay the foundation for sustained and inclusive economic growth in the years to come.